All right, so let me officially welcome you to PE Confidential, my YouTube channel. And perhaps you could start by telling us a little bit about yourself and about Vanguard and what you do.
Yeah, sure. My name is Johnny Jones. I'm a partner at Vantage Capital, and I grew up in North Carolina in the U.S. and worked in New York for KPMG and UBS as part of my background, and then moved here to South Africa in 2009. I had a leverage finance background, and so I joined the Mezzanine fund here at Vantage Capital 11 years ago in Johannesburg, and I've been here ever since. And now I focus on Nigeria and Ghana and South Africa to an extent. We have 15 investment professionals here, and we're all separated into different teams, and I lead one of the teams as well.
And what is your total number of assets under management at the moment? And what fund number are you on? Have you been operating for some years? So what fund number are you on, and what's your total assets under management at the moment?
Yeah, sure. We're about $700 million assets under management, and we're on Fund 3 and about to start raising for Fund 4.
Well, that sounds very exciting. And what has been historically the main composition of your LP base? Has it been mostly DFIs and others? Perhaps you could just give us a sense of the sort of breakdown of your investor base of your funds.
Yeah, it's been about 30 to 40% DFI investors, and but the rest more commercial investors, mostly pension funds across Europe and Southern Africa primarily.
Okay. Okay, that sounds great. I won't ask you about the performance of your funds, but I'm sure it's been very good. Um,
Good, yeah.
okay,
Good
that's
stuff. We're
good.
very proud of our track record.
Okay, great. Have you had many exits, and what's been your experience with exits? Perhaps we could just touch on that briefly, because that's an issue in Africa sometimes, isn't it?
Yeah, sure. We've had 12 exits. The lowest, 12 full exits. The lowest returning one was 17%, and the highest one was 51% IRR. And as a mezzanine fund, we have contractual exit dates for our loan and our equity participation. It's all fully secured with collateral, and so exits are more straightforward. Although if companies are underperforming, there may be more of a fight for us to get our full value, and then things can get tough in a default scenario. But we still have all our legal rights to exit on a particular date.
Okay, that's interesting. Okay, well, maybe let's touch a bit upon the market. Now, I think many people would group the African market in particular and divide it between North Africa, which is kind of linked to the Middle East, and then you've got West Africa, with obviously Nigeria being the big beast there, then East Africa and South Africa. And so that would be one sort of geographical configuration. Is that a sort of way you operate on a geographical basis with that sort of segmentation?
Yeah, it's mostly, well, we definitely focus geographically, and our teams are set up that way. But we do look in those regions and think about those regions being separated similarly. But we also overlay kind of whether it's Francophone or Maghreb, and we have our team delineated that way as well. So we overlay the kind of Francophone and North African nations separate from like Egypt, for example.
Yeah. And do you have any sort of satellite offices, or do you follow a model of sort of a central office in Joburg, or do you have distributed offices? What's your sort of setup that you find to be optimal that works for you?
Yeah, we found the small satellite office doesn't work so well because they don't, the two or three team members there don't really get the recipe that we're cooking up on a weekly and daily basis. And so we have a central office in Johannesburg with about 25 to 30 people, and a small office in Cape Town, which has 5 people. But we engage with them for hours every week on a video conference. Every
Right.
Tuesday and Wednesday, the entire portfolio is covered with them.
Oh,
We,
okay. So you have a weekly conference call kind of a thing to
yeah,
coordinate.
yeah. We think the fly-in model, we're a centralized office location, then we fly into the rest of the continent. We think it works well because we're a debt provider. We have so much collateral and lender rights. we're not really driving strategy of our companies. We're not a majority shareholder. Not trying to create a ton of value through our kind of value-added recommendations. So we think the flying model with all our lender rights and financial covenants is applicable.
Okay, that's very, yes, that makes a lot of sense. I mean, you can see most models as quite a number of GPs, and each one has their own configuration that works for them. Maybe a few words about the market. Now, obviously, we've talked about it geographically. Now, talking about the market broadly as debt related to private equity transactions, which is probably how you would classify mezzanine. In Africa, you've obviously got mezzanine, which is a fairly established asset class within the private equity umbrella, so to speak. But there's also venture debt, which is something that's been growing in the last few years, particularly in the more developed markets. So what do you see do you see a kind of development both of mezzanine, which may refer to larger companies, and do you see a growth in venture type debt as well? Because a lot of the African targets may be smaller SMEs or lower mid-cap type SMEs.
That's a fair question. What we've seen a lot of growth in is mezzanine funding or kind of senior debt lending, with a little more risk that the lender is willing to take. That's where we see the sweet spot of the market in across Africa. In terms of venture debt, we have seen some venture capital funds, and some of them may use debt structures, but they're usually quite small, and there's not a big push in that end of the market yet. And we see big firms like DFIs, like Investec, ourselves, who can do hundreds of millions of dollars in mezzanine or credit, which have some flexible repayment terms. But on the venture debt side, I think the tickets are very small at this stage.
And so it's not so developed, because I was engaged in a debate recently as to whether venture debt could be considered a real asset class, and the conclusion seemed to be, well, because so much of the venture debt was rolled into VC investments, and there's not so many dedicated venture debt players, it's really not emerged as an asset class. And I suppose, would that comment also be applicable to Africa as well?
As far as I know, I mean, we don't look at the startup end of the spectrum so often, but from what we can tell, it's not that developed yet. There are a number of players, and they're growing, and they're making investments, relatively smaller investments. And once they build a track record, then it may get to that level that you speak of. But as we know it today, it's not a huge end of the market.
Okay, well, let's maybe concentrate on the sweet spot, your sweet spot in terms of deal size, in terms of the company size, whether you measure that by sales or EBITDA or other measure. What's your sweet spot and the segment of the market you operate in, according to those variables?
Yeah, we focus on mid-market businesses. The vast majority of our investments have gone into mid-market companies. And by that, we mean kind of an enterprise value below $100 million on the day we invest. And some quite small. Some are worth 15, maybe $20 million the day we invest. And that's what we define as kind of our sweet spot in terms of the value of the company. Our ticket size is anywhere between $5 and $30 million in Fund 3. That'll grow to $5 to $40 million for Fund 4. And that's kind of where we want to play. We don't want to grow much bigger than that. We know some private equity investors on the equity side of our industry who have a minimum ticket size of 40 or 50 or even $60 million. And it's really quite hard to find a good number of transactions, we think, in that space. So we like to focus on 5 to 30 as a sweet spot.
No, yeah, I absolutely agree, because over the years I've often heard announcements by PE funds saying, well, we're going to come to Africa, but we're not looking at deals below 100, 200 million. So I'm just wondering whether they've actually done their homework in terms of their potential pipeline, because they'll end up doing nothing, which we've seen happen with some of the mega buyout funds, where they've opened offices with great fanfare, then closed them because no deals got done. So it's good to know that you're staying within a range where there will be deals appearing. In terms of your deal size, I mean, that would be kind of mid market, maybe rather than lower mid market,
Mm.
the space you occupy. So, what countries have the best capacity to absorb those kinds of amounts? Would it be Nigeria and Kenya rather than Chad or Morocco? There must be some countries where there's more of a flow than others. Also, well, obviously considering the political risk, but just the size of the country and the size of its economy. So where's your kind of best hunting grounds, as it were, for your kind of placements? Let's say.
Yeah, we target 15 countries across Africa, some of the larger economies, and also high in terms of ease of doing business rankings. So you're quite right. Kenya, Nigeria, Ghana, Morocco has been a great source of deal flow. We're closing our second deal in Morocco right now. Senegal's had great growth over the past few years and a pretty good legal regime as well. Egypt has a lot of growth. We've seen a lot of deals there. So, I mean, it's the usual suspects across the continent of South Africa, Botswana, Namibia, where we've done deals in the past. East Africa being Kenya, Uganda, Tanzania. Although there's some political risk issues with some countries, kind of ebbs and flows. So there are a couple of countries that we used to focus on, but not so much anymore.
Yeah, it's usually kind of a combination of the size of the country and the political risk, and then if the political risk goes up, it's got to still be worthwhile in terms of size and so forth. So I think that's what you're saying is very recognizable. Talking a little bit about deal structures, I mean, I won't ask you for your secret sauce recipe, but I will ask you a little bit about, what kind of structures do you use? Is it senior? Is it subordinated? What kind of collateral? Warrants? What bells and whistles do you attach? What kind of rights may you have? Veto rights, board seats? Well, what's your kind of standard product, let's say?
Yeah, so the primary instrument that we use is a loan, either first ranking or second ranking loan, and it has an interest coupon. We sometimes allow interest roll up, and then we have an equity kicker, and we get some relatively small percentage of equity upside relative to the risk capital that we're providing, and that comes through that equity kicker. And then between the two, that's kind of our our two main instruments, but the actual capital comes in through the loan instrument. It has all the lender rights you'd imagine, usually secured by a mortgage bond, interest payment dates, even if it rolls up or compounds for a period of time, it still compounds every quarter, and it's due and payable usually 5 or 6 years after we advance the loan.
Okay, and do you use any more exotic coupon instruments, like maybe a coupon paid in kind with equity, or more kind of customized coupons, maybe deferred payments and other things like that? How much latitude do you give yourselves to sort of tinker with it?
Yeah, we're a very creative team and very flexible, so we do tailor our solution or our structure to the particular investment. But we usually don't go overboard on the way the pick works, or the roll up, how it works. So we usually just say, sit down with management and say, okay, you're going to grow for the first 12 or 18 months. You don't necessarily have to pay interest. That way you can use the cash during that period of time to grow. But then from month 18 or month 12 onwards, you do owe us full interest. And we usually do it that way. To start doing sliding scales and a lot of other funky structures, it does add more flexibility, but usually we just think about a period of time where it works.
Okay. And in terms of the, let's say you're coming in with Mez and there's a bank lender. Do you come to any arrangement with the banks, like with a kind of intercreditor type agreement? Do you talk to the banks? How do you sort of manage the relationship with the other potential creditors?
Yeah, we're well versed in intercreditor relationships. We know all the banks across South Africa. We're fortunate because there's only a few that are very large banks, 5 or 6. We know a number of banks in other markets as well, although not all of them. But we know usually what a senior lender would be looking for, and then that we would be subordinated to them. And we know what kind of rights and terms to negotiate. And we basically have our own criteria, mandate that works for us. We have a flavor for what they're looking for. and we just negotiate in good faith. I mean, it's in everyone's interest to find a good deal that works for the company and the shareholders, senior lender, and us. So we're well versed in that.
And do you actually sign sometimes agreements with the banks, or do you tend to just have a relationship and an understanding? What's the most common way to approach that?
Yeah, we use an intercreditor agreement. Yeah. Sometimes they're short and sometimes they're very long. It just depends on
Sure.
the market and who it is, different types of security. But yeah, it's very formalized, and there's ways that we could default in that intercreditor. There's ways they could default in the intercreditor. So it's very formal. It's in black and white, and we all sign it. So it's very transparent.
No, okay, that's interesting. Yeah, I worked as a bankruptcy administrator many years ago in Italy, and I was always dealing with banks trying to get one over each other to collect the money. So I'm quite well versed in
Yeah,
these issues. So I was interested to ask that question.
yeah.
Let me ask a question about the warrants. I mean, what's your typical warrant? Is it like 5% of the company for $1, or do you have a kind of valuation level at which you price it, which is fixed? How do you structure your kind of equity kickers typically?
Yeah, we usually buy in for nominal, so it could be $1 or $100 on day one, and then it basically has a one-time payment at the end of the term when the loan is due. And there's a detailed formula about how that payment is calculated. And it's usually some percentage of the equity value of the business, and then we determine a formula for how we derive that equity value of the business, and then everyone agrees to the formula and the payment date, and then it's signed. And then everything goes well, we get our money kind of 5 years later, one-time payment.
Okay. And what's your normal strategy to exit equity warrants? Because I can see if you're co-investing and there's an equity fund there, you could exit on the exit date if there's a kind of private equity event, liquidity event. But how do you manage that equity position or potential equity position if there isn't, if you're alone in the sense that you provided mezz to the company? How can you provide liquidity for your warrants? Is it you just kind of wait and see what happens, or do you have some other steps you could take?
Yeah, depending on the company, we basically embed some punitive things that would happen if we don't get paid on the date and at the full value. And we agree what kind of penalties would be in place. And that incentivizes everyone to make sure that on that date, the warrant comes out or the payment comes out.
And presumably, if it's just a small amount of the company, the company could do some sort of leverage recap to buy you out. Was that typically how that would be done? If there's no kind of major exit event present?
Yeah, I mean, we look back at our 12 exits we've had to date, and I think in 10 or 11 of them, we exited through a refinancing, whereas the shareholders who were existing shareholders when we invested, they all stayed into the transaction. And so the goal of our structure is to exit through a refinancing kind of 5 years later. We provide usually growth capital for business, not always, but a lot of times. The business grows and de-leverages over the term, and then it can just raise senior debt to pay out our loan, our interest, and our equity participation as well. That's the model.
Okay, that's interesting. And let's maybe turn a question to sort of managing the portfolio. So once you're in the company, how active are you in the management, say, compared to a kind of plain vanilla growth equity guy? Do you get board seats? Do you want veto rights? What's your sort of a style and approach to managing the portfolio? Or do you have more of a step back like a bank? How do you set about that?
Yeah, we want all the information, and we want to be at all the board meetings, but we don't necessarily require a vote. Although sometimes when we provide a big percentage of the capital, well, the capital we provide is a big percentage of the value of the business, then we may want to vote as well. But we're not driving the business, we're not driving the value creation. It's not really our business model. So we want to go to the meetings usually as an observer and sometimes as a director. We have one vote, usually max. And we let the board decide how the business is going to go. We have all our lender rights, which say that capital expenditure can't be above a certain threshold without our approval. Other payments or distributions can't be made without our approval. That's in our loan documentation. So at the board, we're really just trying to make sure that the risk return profile is balanced. But we do look at not just the downside, because a lot of banks focus on protecting their loan. We've got an equity kicker as well, so we want to make sure some value is being grown at the same time.
Okay, so you're sort of a bit more towards the bank than towards the equity guy, but you sort of keep you kind of keep this observer position on the board, so you try and have more of a voice than a regular bank. Would that be a fair summary
Yeah,
of
that's it.
your portfolio? Yeah.
That's it.
Okay. And who are the other players in the market? Obviously, I've done a bit of research. Obviously, Vanguard is a major player, but in terms of this mezz space in Africa, who are the major other, not really competitors of yours because it's probably quite a virgin market, but who are the other funds that operate in the same space as you do, and do you ever work with them?
Yeah, there's Investec, and some of the banks have leverage finance groups, principal finance, and they do similar structures. Standard Bank has a group that does a similar structure. We don't take quite as much risk as we do. Typically, those banks don't, but some do. Some, they would say, they push the envelope and do the exact same style structure we do. In terms of independence, it's Ethos Private Equity has raised a mezzanine fund, and Barak Fund Management, they do private credit as well. Different structures. Each one has their own niche, but they're in the private fund management business. See a few DFIs that do it as well, some direct investing through private credit.
Okay, that's interesting. Okay, so but would you say, and so it sounds like it's quite a virgin market. I mean, do you find that you don't really compete for deals, and that you've got your pipeline is pretty full and you can kind of pick and choose? Is that your experience at the moment?
It is our experience. We actually do analysis to see how we lose deals that we spend a lot of time on, and it's rarely to an independent private credit mezzanine fund. Very specific niche there. Sometimes to a bank, and more times to private equity or an equity investor. We think we're an alternative to equity. We don't really compete with banks because we cost more than bank funding costs. So really our competitor is equity. Sometimes we lose deals to equity, but not so much to the independent mezzanine players.
Yeah, I understand. Yeah, I mean, that does happen sometimes, particularly when the owners of the company are a bit confused whether they really want mezz and equity, and you end up spending a lot of time, and then they decide to go with equity when they could have figured that out a bit earlier. Perhaps.
Yeah, that's right.
But you know, it's a young market, and company owners need to be educated without getting into the free education business, of course. But what would you say are the main risks that you have to manage? Maybe compare it to, say, the sort of risks you might have in a developed market like the US or Western Europe. What are the specific African risks that you have to manage that are very prominent?
Yeah, I think number one is currency. I think one reason private equity, the sector, broadly speaking, private equity, which we're a part of, hasn't done as well as it should have, is because currency has been really been a real disadvantage over the past 10 years or so. And you see it across the continent, from Egypt to Nigeria to the South African rand. And if you're making hard currency investments in these markets, and then you mark to market at the lower currency values, you lose a lot of value that way. So I'd say that's one of the bigger risks. We see importation of goods and repatriation of capital out of countries as being another big risk in several countries like Nigeria, for example. And then we see that government gets involved in different pockets of the economy, and you'll see some big, even in the private sector, big companies sign deals or supplier agreements with government-owned entities, and then there's a new election, and then they change the terms of the deals, even if they're all kind of binding on a bilateral basis. But because the government no longer supports that particular deal, that can be state government, local government, or federal, then you may have a big risk. They may want to renegotiate all the terms of the contract. So I'd say those are three of the big ones we see on a regular basis.
But I assume that being mid-cap, you wouldn't have any kind of direct government interference in your actual deals. It's more the sort of general environmental question. Would that be right?
No, I mean, a small business may have 40% of its revenues being provided to a government-owned energy company, for example. And then there's a new energy minister elected or appointed, and he's changed the strategy completely, even though the old minister said for the next 10 years, we're definitely going to do X, Y, Z. So those things can change around, and now you're not on as solid a footing as you thought you were, even for a small company.
Yeah. Well, if it's any consolation, I was managing a renewable energy fund in Vienna, and several West European governments tore up their subsidies and their offtake contracts. So if that's any consolation to you.
It's rough around the world, I guess. Keeps you nimble.
Keeps you nimble, yeah. Okay, well, maybe the last topic I wanted to touch with is the composition of your team. So we talked a little bit about your offices. So what's the kind of ideal skill set and background for a mezzanine fund investment officer, let's say, compared to, say, an equity person? Would they have a background more in structured finance, less operational? What's the ideal profile of a team member in your kind of product range?
Yeah, I mean, at the junior level, we'll take anyone who has either equity investing skills, maybe from a private equity firm or an investment bank, or someone who's worked at lending, corporate lending to small or medium-sized businesses. Usually the best skill sets, project finance as well. At the more senior levels, though, usually you need someone who's worked in this kind of quasi-debt and quasi-equity and has that background, where they can think in terms, put an equity hat on for a while and a lending hat on as well, because the skills get very specific as you get more experienced professional. So we look for both at the more senior levels.
Okay, that's very interesting. So I guess my last question to you is, how do you see the market developing, let's say, over 3, 4, 5 years in Africa, in terms of the geographies, in terms of the kind of products that you might be doing, in terms of the players? Well, what's your sort of general idea of, is it a good place to be for the next 5 years, Mez in Africa?
Yeah, we think so. We think it'll grow, but grow gradually. We don't think it'll be one of these leaps and bounds. I mean, you could have seen how private equity grew almost exponentially back in the 1990s, early 2000s, that kind of time period. And they had the returns to go along with it. Here, with so many different markets, it's different than if it were just one country, and Africa were just one country. It's 55 or so countries, and to go cross-border between two adjacent countries can be very difficult. Different regimes, different governments, different election cycles, all types of different business issues. So we think there'll be regional players and maybe a few Pan-African players, but they'll focus on mid-market. I think the growth's in the mid-market, and it'll be gradual going forward. I don't expect to see a billion-dollar private credit fund that can invest all over Africa, because you really have to learn each market that you're going to invest in.
Okay, well, that's great, fascinating. I think you've answered all my questions, and you've answered them extremely well.
Yeah.
So thanks a lot for your time. I don't know. Do you have any questions you'd like to ask? Me or anything about my channel?
Yeah. Who's your typical audience?
Okay. Well, the channel, I started it a year ago, and then what happened was that during the lockdown, I had time on my hands at home, so I really had to go at developing it. And when I was a teenager, I'd worked in the film industry because when I was like a student, because I grew up in Italy. So I sort of repolished my video skills a bit. And my audience, I've got about 3,500 viewers, and they mostly consist of financial professionals, either in private equity or interested in private equity by virtue of maybe being in bank or the service industry like lawyers. And they're mostly concentrated in the emerging Europe, the Middle East and Africa. And they tend to be more, let's say, call them mid-ranking junior professionals. So that seems to be my core audience. I guess you could say the generation that is the YouTube generation, which obviously is certainly not my generation. I don't know if it's yours, but those are the people. So it's very much. I do have a pretty strong following in Africa, so I think a lot of them will get to see this. And then I use my LinkedIn profile also to sort of draw attention to interesting films. So I have no doubt that this will get a wide audience and a lot of interest.
Okay. And even during COVID times, you're seeing continued interest in offshore investors looking to invest in Africa.
Um, I think Africa is it's always been a bit of a sleeping giant. I mean, I've been working with Nigeria for 10 years, and the potential is there. You know, it's 170 million people. It's taken them quite a few years to get to the point where they have a fairly developed PE industry. You know, they've got ACA and they've got maybe 6, 7 other groups with about 100 million plus each, but that took a long time to develop. I think Africa is the smallest market. You know, you can't compare it to India and China, the big Asian markets, which is about 2/3 of the emerging markets. And then you've also got Latin America, which is a kind of American colony, emerging Europe. So Africa, and then Africa is complicated because you've got North Africa, which is kind of linked to the Middle East. You know, you've got a lot of investors in the Middle East, so it's a bit of a special animal. But I see it sort of a gradual, steady growth over the years. It didn't suddenly have a boom like Central Europe where there was a system change. So it's more a question like most countries, like they'll take 2 steps forward, then the next year they'll take a step backwards. So you've sort of got to be in there for the long game. That's been my experience of somebody who's been working with African private equity, mostly as an advisor, but for many years, for 15 years or more. So that's been my experience, and I'm hoping it's not a market that you sometimes get some territories that have better years and some that have worse years. You know, one year something happens in Nigeria, another year Uganda's doing well, and then it reverses. So you've got to sort of be diversified and kind of play the long game. At least that's I don't know if that corresponds to your experience or not.
No, it does. Definitely so. Definitely so.
Okay, well, let me not take you any more time. I will certainly try and meet with you as and when we can start traveling again, and I get over to Johannesburg, and if you do come to Europe, please reach out. But thanks a lot for your time.